My name is Helen Gonda. I am a mortgage broker based out of Nova Scotia. I'm also a real estate investor. And today with me, I have Milan Gonda, who's a realtor, a real estate investor, and
Also, your favorite husband.
today we will be discussing the topic of the new program that Nova Scotia just rolled out. It's the Nova Scotia Down Payment Program for 2%. For the first-time home buyers. So what we're going to talk about today is we're going to dissect the program. I have seen this since February 3rd when it launched. A lot of content online from realtors and other people just kind of sharing the program. And I'm seeing a lot of misinformation, and I'm also seeing just the basics of, you could buy a house now in Nova Scotia with only 2% down payment, but nobody's actually diving into the details of it. So today we're going to be dissecting the new program for first-time home buyers. So let's start with the qualifications. Nova Scotia Down Payment Program for the 2% is specifically for first-time home buyers. Who is a first-time home buyer? Because there are qualifications. So it's somebody who has never purchased a home. First-time home buyer is somebody who has purchased a home in the past, but they have been off mortgage and land title for a minimum of 4 years, or somebody who's going through separation or has gone through divorce and has lost their marital home or sold their marital home. They actually qualify as a first-time home buyer. So now that we have that specified, we will go into the details of how is this possible? How is the province doing this? Because everywhere else in Canada, the minimum is 5%. Well, they are bypassing the federal program through the mortgage insurers by lowering the down payment and using the credit unions. So this program is only available with the credit unions. Because it's not a federal program, it is a provincial program. You can still go through your mortgage broker. You still can get the details through your mortgage broker. And there's only a list of participating credit unions. So it's not everybody. Talk to your credit union to see if they participate, or talk to your mortgage broker to figure out who you could go through. But the good news is that most of the people that live in Nova Scotia have access to at least 5 credit unions, and pretty much I've seen all of them on that list. So we're going to be talking about what you need to qualify, which is available on the government website. Again, I mentioned that what is a first-time home buyer? You need a maximum household income of 200,000, no more than 200,000 household income. Household means you, your spouse, whoever else is on the mortgage application, maximum 200,000. You still have to pass the affordability stress test. You still have to qualify under the regular mortgage insurers guidelines for what is acceptable for affordability. You talk to your bank or mortgage broker. We're still doing the same application we were doing before this program rolled out, but with a slight twist to it. Your minimum credit score requirement is 630 or higher. Now, if you are new to Canada, or if you are PR, or if you have thin credit, there are ways that we could still make this work, but you do have to have a credit score of 630 or higher. Now, you must be either a Canadian citizen, a permanent resident, or an immigrant with an endorsement certificate from the Nova Scotia Provincial Immigration Program. This information I saw not available everywhere, but when you actually look into the details of the program, it is on the provincial website. But if you look on the credit union's websites, they don't actually share that. So the maximum purchase price, which is all the hype that we're hearing, the maximum purchase price is $570,000 in HRM in the Halifax Regional Municipality and East Hants. And the rest of the province, the maximum purchase price is only $500,000. Now we're going to look at some facts and dissect this program very quickly, and then we're going to talk to our realtor about what this means for you. So we're going to start with the facts. There is still a sliding scale that applies. A sliding scale is applicable to all purchases in Canada. So when you're buying a house, for the first $500,000, your down payment is Normally it's 5%, but in this case it's 2%. And then for the remainder, it's 10%. So if you are maxed out at a pre-approval of the 570, you're doing 2% on $500,000 and then 10% on the 70,000. And your broker and your bank will tell you what the actual down payment amount will be. If you're only approved for the $500,000, your maximum down payment is 2%. There is no mortgage insurance premium on this, which is a fantastic aspect of how this has been set up by the provincial government. We'll get into that more shortly. The household partners who live together for at least 12 months can apply together, or newlyweds. A lot of the times when you apply with a bank or a credit union, you have to be common law, or you have to have a certain kind of a relationship with a person. Under these rules, your household partner who lives with you for at least 12 months can apply. We have to kind of dissect that more with the lender, but it seems like whoever you live with for 12 months can be applicable for. It doesn't say that they have to be common law, but they can be newlyweds. This must be your primary residence. So you're a first-time home buyer, and this has to be your primary residence. What does not qualify is you do not qualify if it is an investment property. It doesn't qualify for multi-unit properties. This is specifically for your primary residence. Program participants who want to renew with another lender or bank outside of the credit unions must pay off minimum 20% of equity in their home. This is a big one that we're going to be talking about in a few minutes here. The eligibility of homes. So these are the types of homes that are eligible. You have detached, semi-detached, row housing, condo, prefab homes, and mobile homes. New construction is not applicable, and construction loans are not applicable, and rental units, Airbnbs or cottages, they're not applicable to this program. Down payment must be from own savings. So I was actually looking at this last night, and on the provincial website, it only states that you have to come up with 2% down payment. So the provincial program doesn't specify it has to be from your own funds, but when I go into the credit union's websites, on the actual credit union website, it specifies the money has to be from your own savings. So this program, being brand new, just rolled out this past week, there's still the credit unions are still trying to refine the process and define the provincial rules. So you have the basic provincial rules, but then you also have the credit union rules. And the credit unions will have their own interest rates, and they'll have their own add-ons to the rules. So it's really good to talk to your mortgage broker first so they could figure out which of these credit unions would be the right fit for you, versus just to go to your credit union. You know, they have their own rules, but then you go to a different credit union and there's something else. It's a lot of information when you're talking about 5 or 6 different credit unions that are available to you in your area. The maximum amortization is 25 years. Now, the federal government had rolled out a program to allow for 30-year amortization, but because this is a provincial program, you can only do it at 25 years maximum. The guarantee from the province, this insurance that they cover for you, is guaranteed for up to 15 years of renewals. And you must show enough money for closing costs. Again, this is not on the provincial website, but it is on the lender's website. So the credit unions specify that you have to still show the 1.5% for closing costs, and you still have to show that you can afford to pay for land transfer tax, property tax. You still need money for that. So if we're talking just down payments, 2%, yes, but the rest of the money you still have to come up with. So at least 3.5%. Plus other fees, lawyer fees, you're looking at least 4% at the end of the day. Refinancing at renewal is not permitted unless you paid off the 20% of the home equity. This is a huge one because most people in Nova Scotia are used to buying a house, and because our real estate market has been growing exponentially over the past decade, nobody thinks about paying off their mortgage because the equity has grown so much. If you bought a house 5 years ago for $500,000, now it's worth closer to $1 million. You have a ton of equity just from the natural growth of the real estate. With this program, they're specifying that you have to pay down 20% out of your own pocket. Now, will this be refined down the road by other credit unions? We're still not sure. But as of right now, the wording is specifically states that it has to be paid off. It doesn't mean that you have to own that equity. It says that you have to pay it down. That is a big one because a lot of Nova Scotians refinance their home to pay out their debt. I've at least once in my lifetime, I have used my personal mortgage for that as well. Most clients will do the same, that if they own a house and they want to refinance to reinvest, or they want to refinance to pay out their debt or do an addition to the house, they're not able to do that through this program unless they've already paid down and own 20% of equity in the house. So we've talked about what's not eligible. We talked about the basics, and we're going to chat with our real estate agent here and discuss what he thinks. We're going to talk about how this is going to affect the market, and then we'll dive in deeper into each of these individual details and dissect it one by one so there's a better understanding of it. Milan, thank you so much for being here today. How are you?
My pleasure. How are you?
Please tell me what you think is going to happen now that this program has rolled out with the real estate market in HRM and outside.
It's still early days. We still haven't seen all the details, so we're going to have to make some assumptions. But the assumptions that we're looking at right now look quite good. It's very enthusiastic for first-time homebuyers and trying to find that place. When I'm talking to clients or potential clients, the first thing I'm going to ask them is what their goals are for the 5 years going out, and seeing what they actually want to go. Because generally people wanting to get into their first house, they might be starting a family, they might be growing, and generally people move several times during their lifetimes. So I want to make sure that the house that they're getting into at the first step is going to help them get to the next step. So this first-time homebuyer program is definitely enthusiastic from my standpoint. It helps more people come to the market. That being said, it's going to add more buyers to a market that is currently very saturated. So just last week, talking to one of my colleagues, they had one property, and about this that would qualify for this price range, had 16 bidders on it at the current 5% down, stuff like that. This program won't help. It might, instead of 16 bidders, might be 20 bidders. That is not going to help anything. It's not helping the supply issue. But what it does help is people who can look outside the city and at that kind of price range. So you're not going to be finding a place downtown Halifax for $500,000 for a house. That is not what this is going to be helping for. But people who want to look closer to the outskirts, your Enfield, Fall Rivers, closer to Tantall and Lawrencetown, those kind of areas, people pushing outside of HRM, then more in their price range. For people who don't have that down payment, it definitely brings more buyers. Now, the biggest thing that, from my standpoint, from the numbers, is what really helps people is generally CMHC fee is very heavy, especially at 5% down. When you have 5% down, as you know, 4% of that is going to be a CMHC fee, which, if we're looking at a $500,000 property, is $20,000 that if you just off the first purchase, you're going to be out that kind of money. Housing at current, if you have 5% down, if you were to buy it today, sell it tomorrow, in theory, you'd be down almost 10%. So if you bought your $500,000 property and you sold it tomorrow, you'd be looking closer to losing $50,000. With this program, essentially subsidizing mortgage insurance, that would save you that $20,000 spread. So when I'm talking to clients about looking 5 years in the future, that $20,000 based now is going to be $20,000 in their future for the next purchase, for upsizing when the family grows, and just having more equity in that house. If they want to borrow from that house, that is more equity in the house that they can purchase from. So from my perspective, it's looking fantastic. There's many levers that the government can pull when it terms of increasing housing supply, demand, all that kind of stuff. If we're talking in theory, if you want to crash housing prices, you just get rid of, make loans illegal, make people have to pay cash, guaranteed housing prices are going to come down because people don't have access to capital. The more people have access to capital, the more it increases prices of real estate, all things being equal. So when we have this program that can actually add liquidity to the market and add more access to capital, it will inevitably raise prices. Now, what's good about this program is it doesn't increase the maximum amount people can borrow, because they still have to have the stress test, they still have the ability to pay. it's not going to increase the total amount people can actually borrow. So it won't have that upward pressure the same way lowering interest rates do. Because for people that don't know, the lower interest rates go, the more people can borrow. And so that's where you get these bubbles that happen. And we are seeing the repercussions of what happened when high interest rates had devastated the market, like in the GTA right now, or Vancouver, or Calgary. Nova Scotia currently doesn't have a development problem of overdeveloping like those areas do. So as we like to say, real estate is always local. And Halifax is very local. Sometimes we're talking down to the street, and even parts of that street, kind of local kind of areas, can affect the price of what that house is, because Halifax is relatively distinct in that way, just the way the geography is, its limitations being on the water. It's definitely a different factor than, say, like Calgary, which can expand outward basically indefinitely. It doesn't have limitations by being close to the ocean, and they had the strong development base. And when you have a strong development base and properties rise, that development base can really turn things on. Nova Scotia never had that development base to begin with, but we had the boom, and we're getting a bit of a delayed reaction to that. So development is coming. Financial tools can be turned on and off. It's like a speedboat. It's really easy to turn around a speedboat. Turning on and off development is like turning around a cruise ship. It takes a long time. It's going to take years. And there's been a lot of steps towards that, bringing in more trades, trying to make it easier, less permits, or make the permitting process easier. But it's definitely going to take more time. But from your perspective, are you seeing a lot of interest on this new program from your clients?
I have. I've had a lot of phone calls this week alone, and it just rolled out on the 3rd. So while we're filming, what's today? Today is the 6th. So it's only been a few days, and I'm already getting phone calls. And so, of course, what I've done is I had inquired with several of our credit union partners on the program, and they're still rolling out the details. A lot of their websites don't even have this program yet because it was just kind of rolled out without them smoothing out all the details. So from what you're saying, from what I understand, is that it will probably saturate the market. So people who are pre-approved for under this 570 amount, you're all of a sudden going to see a little bit more people. So there's going to be more bids on houses under 600,000. You're going to see those houses sell a lot quicker now because there's just going to be so many more people there.
Yes, certainly. When you bring more buyers, when you add more liquidity to the market, it is inevitably going to have a positive increase on the price of the property. So if I'm looking at properties that are at in around this kind of price range, and I know it's going to be maxed out at 570, I would be reluctant to advise any client to go above that price or below that price. So if they were thinking at listing at 550, and we know that it's a super competitive market and everybody can have access to this 570, that likely that we're going to end there.
So if your client has a property that could sell for like 590, let's say, would you advise them to list it for 570 if you want a very quick sale?
It always depends. I can't give advice to non-clients and theoreticals I got to be careful with, but it would be more pushing not from the 590 down, it'd be more pushing from the 550 up. Mm-hmm. So if we're seeing these properties at like 550, and I know that there's multiple bidding situations, and I know the access to capital to 570 is very easy, I would not be doing my clients any service by saying you should list for 550 unless I expect a bidding war to 570, which might happen inevitably anyways.
So what you're saying is basically we're going to see not only the houses that are under 600,000 sell a lot quicker within HRM and outside of HRM, but also you're going to see a lot of the housing market inflate for between the 400 and the 600,000 price range. So if somebody's house is worth 5, they know they could probably ask for 550 because this program rolled up. More people have access to money now, and then people who are listing their house for 550 could sell it for 570 because it's just going to sell because like you said, there's 16 people bidding on it.
Yes. So what I see this actually affecting more the outskirts of Halifax and Dartmouth as opposed to inside, because as we say right now, going from 16 bidders to 20 bidders is not likely to move the price much. This also doesn't increase the ability to people for borrowing more. So if they're maxed out, they're maxed out. What I do see is those 4 extra theoretical buyers that were bidding on this property now have access to other properties outside the city. And that's inevitably what happens. I mean, we saw that during COVID, of how big the expanse went as demand went crazy and supply is very short. You had bidding wars in Enfield and Tantallon and out way past what is normally considered the rate. Like Fall River, for example, normally takes 90 days to sell a house, for example, or before COVID used to take that long. During COVID, less than a month, less than 30 days. Now we're renormalizing back to that regular market. But for properties that are in that price range where people can afford, and that kind of 570 and below, we just have a little bit more fuel for the fire for people to actually purchase that. It's going to bring a few more buyers to that kind of market. I mean, in your experience, do you see a lot of people who are close to that 5% down payment, but they're just kind of on the cusp that this program would actually help significantly?
I think it's too soon to say. I see some benefits to this program, but I also see benefits to other programs out there for first-time home buyers. So I think it depends on each person's scenario. Like you said, it will have access for certain people. Right off the top of my head, I can think of people who are first-time home buyers and they want to save up money, but they also have debt. Instead of doing 5% down payment, they could focus on saving up only 2% and then using the other 3 that they were going to save for a house to pay down that debt to qualify for more. So I see it being a benefit in that sense. Is it going to benefit every single person? No, it's not, but it will definitely maybe about 15 to 20% of people that are trying to get into the market, it would help them. So today we're talking about the Nova Scotia 2% down payment program for first-time home buyers. And we're actually going to dissect this program into detail for people to understand more of what it is, who will it benefit, and for you to understand, is this the right product for you? We talked about earlier in our previous discussion with insurance premium versus no insurance premium. For those who don't know what we're talking about, for just a regular viewer, what I want to say is when you're buying a house in Canada, you fall under the federal guidelines of what are you purchasing it with. Are you buying it under 20% down payment or with more than 20% down payment? So in Canada, the rules are if you're purchasing a home with less than 20% down payment, you automatically pay into a mortgage insurance premium. That mortgage insurance does not cover you. It covers the lender if you default on the house. So if you go into bankruptcy, the lender is covered. That way they can offer you really good rates and you're lower risk to them. That is why that program exists. There's 3 mortgage insurers in Canada, and there is a scale of what the insurance premium is based on your down payment. So today we're talking about minimum down payment because we're talking about the Nova Scotia minimum down payment program. If you were to buy through the federal program with the 5% down payment, you're actually paying 4% on a mortgage insurance premium, which is added at the beginning of your mortgage. So if you do 5% down payment on a purchase price of $500,000 and the mortgage insurance premium is 4% and it's added back to your mortgage at the beginning of the term, you've only actually done 1% down payment on the purchase of your home as when you're buying it. Now with Nova Scotia, how they're able to bypass that is this is a provincial program and they can only go through the credit unions because the credit unions are only provincially regulated. Credit unions are not federally regulated entities, so you don't have to follow the federal regulations of the 5% down payment and you don't have to go into the mortgage insurance premium because now Nova Scotia is acting as the insurer for those credit unions. So what does that mean for you as a buyer? With the 2% down payment, there's no insurance premium. The province covers that on your behalf. Now, this has limitations for what you can do if you are going under this program. So If you are buying with a 2% down payment, again, let's use the numbers of 500,000 as the purchase price, and you do the 2% down payment, the province of Nova Scotia is actually acting as a guarantor for that insurance for the credit union. So if you default and you go into bankruptcy and you have to get rid of your house, the credit union is not out all of that money that you put down, that you owe on the mortgage. The province will come in and cover that for you. Now, the limitations on that, apart from just the basic application, is renewing and refinancing. That is the biggest thing I haven't seen anybody talking about yet. So you have to, if you're going under this program, again, 2% down payment is very little. So if you want to go to another bank in 5 years, or if you want to renew with another monoline mortgage lender, you have to own and pay off at least 20% of the equity in your home before you can go outside of the credit union. So that means that if the credit unions in 5 years' time decide to raise their rates by 1% more than the regular banks, you have to be able to pay off 20% of your home equity to go somewhere else. Now, the rules on this are not defined. And again, because this program is new, I had questions that no one's been able to answer yet. And once I figure it out, I will post about this. So my first question was, okay, is this asking about 20% of equity that I own in the house? Because the housing market here is growing. So I could potentially have 20% of equity in 5 years at renewal if the housing market continues to go up. Or is it talking about specifically me paying off 20% of equity? Because that's a huge difference, right? Most people don't pay off 20% of equity in their first 5 years of their mortgage life. And the reason being is that when you get a mortgage or you get any kind of loan in Canada, the first 10 years of that loan's life, you're paying 2/3 of that onto the interest and about 1/3 of that on the principal. These aren't exact numbers, but this is for reference, that the majority of the money actually goes on interest and the small portion goes on the principal balance. So over the first decade, you're really paying out that interest. And then over the last decade of your mortgage, you're slowly paying down the principal. So in this case, nobody's been able to answer me yet on how that actually works. And then the other thing is, if I'm selling my house, is there any implication or any penalties? I haven't heard on that either. So we're still looking into that, and we hope to hear from either the province or from the credit unions themselves on how that is applicable. And the other thing is refinancing. So most people who own their house, at least 2 in 5 people that I have as my clients, will refinance their mortgage within 5 years. They refinance because they need to get low interest rates, and they need that money to either pay out their debt at high interest rates like car loans, lines of credit, credit cards. They need that money to reinvest into something else. Real estate investors use their homes, take out equity to buy another property. If you're talking about refinancing for like a spousal buyout, things like that, most of the time there's set rules for that, but this has not been refined yet. There's still it literally just says that you can't refinance your house unless you own 20% of equity, which is true for pretty much every lender. You have to own 20% of equity in your home, but here it doesn't specify if I have to pay that 20% off out of my own pocket, or if it just has to be 20% of equity because the market has naturally grown in Nova Scotia. So that has not been refined, and I haven't had answers on that yet. I'm curious to see what that is going to look like in the near future. And the other thing you were talking about is insurance premium versus not insurance premium. So if I was to buy a house today with a 2% down payment, no insurance premium, and if I was to buy the house at 5% today with insurance premium, and I was to sell both houses, I would walk away with, not wasting any money from the 2% versus actually losing money on the 5% because I only actually put down 1%. So there is that difference, right? You do have quite a bit of a difference. Now with amortization, which is another one, the federal government recently rolled out last year the program for first-time homebuyers being able to do 30% down payment, which puts them in a higher bracket of what they can afford, because that 5 years of amortization lowers their monthly mortgage payments significantly. And this program only allows up to 25 years because you can't combine programs. You can't have the federal program and the provincial programs mixed. This also means that you can't do purchase plus improvements or other federal programs through the insurance premiums that are available with this program. So you can't mix and match stuff. You can't combine different things. So this is where it plays a role of importance to talk to a mortgage broker or the credit union or a specialist who can answer these questions, because I had to research all this information and every credit union had different information on it. The provincial government rolled out their program of what is eligible for this 2%, but they're also allowing the credit unions to add their own rules. So that's very crucial that you talk to a broker and they can help you find the best option for you for that.
So this is a program is essentially a subsidized mortgage insurance, which if it's eligible and the interest rates are competitive, then it's going to be a no-brainer. If the interest rates are not competitive, so they put a limit on it of prime plus 2%, which would be looking at about 6.5% compared to what you can get today at about 4%, that would not make any sense. So on a $500,000 property, if you save the $20,000 in CMHC insurance, but then you're paying 2.5% extra on that $500,000, well, that $500,000 just cost you tens of thousands of dollars. So then it wouldn't make any sense. Now, we're still waiting for the details of what the interest rates will actually look like, and that'll determine what works best for our client at that point. If they are competitive, and you can actually save that money, you're going to be in a much better position going forward.
I would say that each credit union is probably going to do what they have been doing for other programs, and they're going to set their own rates. I have a feeling that the interest rates for this program are going to be higher because it is backed by the province, but it's a pilot program. Therefore, if I was a credit union or if I was a lender, I would consider this higher risk because I don't know what, there's no history of how this would look like. So I would roll this out at slightly higher interest rates. Now, I don't know how high they are, but the provincial government did say to the credit unions, hey, you can set your own rates, but it can't be more than whatever the Bank of Canada Prime is plus 2. So it cannot exceed that. You can't just make up your own rates and exaggerate them. This is your cap. But we will see what the rates are like for each credit union and see who has the most competitive rates in the next couple of weeks here. I have seen on a lot of the websites that it's either not even mentioned or some of the websites say we're working on it. So I'm excited to see what they come up with. And then the other thing to note for people just in general, why would you go to a bank versus a credit union? What is the difference? A lot of the times I will take my client to a credit union if a big bank or the mortgage insurer does not allow for specific things, because again, when they're federally regulated versus provincially regulated, they're different programs. So a lot of the times challenging homes or challenging situations that might not qualify with a bank, they may qualify with a credit union. You may be able to get certain approvals that you just can't get somewhere else, and that's because provincially regulated, there's less constraint.
Yeah, no, generally I would expect the credit unions to have higher interest rates just like they normally do for most products because their access to capital is different. It's more local. They fall under a different schedule of a different type of bank. So their access to capital is just more expensive and they have to pass that along. Same thing with this program. It's guaranteed for 15 years. under CMHC, if I'm not mistaken, it's guaranteed for 25 years for the actual mortgage insurance itself. So the question would be, what happens after that 15 years? And if the credit union is accepting the risk after that time, then that's also going to reflect in the interest rate because they are accepting more risk at that point. And also the province is only covering 90% of the losses for this insurance, which compared to CMHC. So higher interest rates would be expected for this program. We just haven't seen those numbers yet. And when we have those numbers, then we can advise clients of what makes the most sense and what you can actually see going forward. And at the end of the day, my goal is to put the people in the best position. So going forward, so this first house is not their last house, so they don't get stuck in their property. Because nothing is worse for people that you buy a property, you put 5% down, you're immediately underwater because your CMHC fee, life happens, life changes, and then you need to get out of that property, but you can't because you're just economically stuck in that property. You're seeing that a lot in the GTA right now, where people want to leave, but they're underwater. They can't actually afford to sell because they can't pay out the difference. So a lot of people are just hoping things recover, and hope is not a very good financial strategy. It's emotions and money never mix, and I like to keep those as separate as possible, which is why I like numbers. Numbers bring me comfort, and when we get the numbers for interest rates, then we can actually move forward with that, as opposed to just jumping on the bandwagon of this is the bee's knees. Everybody should get a 2% down mortgage. We need to see the numbers first, and then we kind of gotta go from there.
Yeah, and I agree with that. I think now is more important than ever to work with a mortgage broker versus a bank or credit union specifically, because if you go to your mortgage broker, for me, it's easy math to sit down and say, is it easier to do the 2% down payment, and is it easier to do the 5% down payment? Because every person is different. Your mortgage pre-approvals, they're tailor-made. They're very customized. When you go to a bank or a credit union or do an online application, you're not actually looking at what your proper pre-approval numbers are. You're not looking at the details. You're not getting any of that information. So realistically, when you work with a mortgage broker and you're working with a professional who wants to get you into the market, who wants to get you the best, and qualify you for the most so you can actually buy a house, so you can get into the real estate market and have those options. You might not want to buy a house for $570. You might want to buy a house for $500, and that is up to you personally. However, it's our job to give you these options, to run the math for you, and it's very easy to do that. It's a simple application that we fill out and get your information, and then just compare the two different programs. And there might be other programs that you're eligible for that you don't even know about. Nova Scotia still has the down payment assistance program. Now, with this program rolling out, we were talking about, are they going to get rid of the down payment assistance program? Because I don't know how we can afford both programs, to be honest.
What seems to have happened is the utilization of that program was relatively low. So that's why they're coming out with a new and improved program. They seem to talk to people, what was the issue? And I'm sure you've seen the issues of what that program lacked and why people didn't actually engage with it. This program seems to be better off the cuff. It seems to have a better standing. We'll know once we get the interest rates actually start rolling out and what that actually means for people, if it makes sense. I mean, at the end of the day, it has to make sense. And the last program didn't make sense for a lot of people. This one, off the current how it stands, looks like it will, but until we get those numbers, we won't know.
I think with the down payment assistance program, the biggest hurdle was the maximum household income, which I believe is $140,000. So assuming you have zero debt, your maximum purchase price is going to be around $550, $560, just based on the household income alone. And you're not really finding anything in the city for that. So they would need to raise they don't have to raise the down payment amount, but they need to kind of tailor that program to work realistically for household incomes, right? And of course, the other is part of that is you can't have your own down payment. So if you have no down payment at all, they'll help you with it. You still have to have money for closing costs. And then, of course, the other part of that is the purchase price. So they also have a purchase price limit. Now, for this one, I'm also curious to see if it's going to be similar to the down payment assistance program that Nova Scotia has, because you can go over the limit of what their maximum purchase price is. You just have to come up with that money yourself. So I have seen people go over the limit, right? Because the Nova Scotia Down Payment Assistance Program also has a purchase price limit of that 5% that they give you. But you could still buy a house for more money. You just have to come up with the difference. You have to be able to afford the difference. And they had allowed that. I've had clients in the past year go for that, because technically they don't have the 5% for the full purchase price. They have some of it, but not all of it. And so we've seen that work, but I think they need to really raise the limit on the value of the house, and they really need to raise the limit on the household income for that program to be utilized more. And I think there's also, again, misinformation and misuse of that program, and some people just don't know how to use it. They don't know what to do with it. I love that program. I think we're one of the only provinces in Canada that run a program like that properly, and I would love to see it continuing here for first-time home buyers so they can get into the market. Because with that program, it allows people to focus on paying out all of their other debt, their student loans, their car loans, their credit cards, and focusing on paying out debt, and then using the down payment assistance program to help them purchase a home, which is an asset versus a debt is a liability. I always talk about my videos. If you have what is an asset, what's a liability? Car loans are the killer of assets in my mind, because as soon as you get a car loan, it depreciates in value. The monthly payments are ridiculously high. Most people pay between $500 and $600 a month on their car loan. And if you have bad credit, or if you have a really expensive car, you're paying $800,000 to $900,000 or $900 a month on a car. That is a lot of money. That really reduces how much you could afford on a house.
The biggest downside I've seen with people financially is buying a car. Is people need a car and they justify overspending on a vehicle, and then financially that's what really hinders them from buying a property and stuff like that, because those down payments are what really kind of kills it. And people, it can't be emphasized enough that if you're looking at buying a house, you really got to make sure that your payments are in control, and vehicles are the worst offender. But this is just a pilot program, and the government seems to be reactive to when programs fail, like the previous program, just very low engagement. And we've just seen that recently with, they just announced this past week about the backyard suite grant, essentially $13,000 to fix plumbing and stuff like that, so you can actually have a secondary suite in your backyard. The engagement was incredibly low. I believe the actual active permits that actually went through were 22.
Because you can't build anything for 13 grand. Like, we were talking about this so many times. I've talked about this to other realtors. I just thought it was such a silly program, because if you're adding a suite in your backyard, the plumbing to run the sewage pipes from your backyard to the city alone would be that 13 grand.
And that's essentially what it was meant for, is just the plumbing. The rest of the house is up to you.
Yeah.
And it's a bit of a chicken and an egg situation of people who could really use the income from a secondary suite don't have the money to build a secondary suite. They'd have to get a loan. People who have the money to build it don't want a secondary suite in their backyard. So unless there's a larger financial incentive, getting just a handful or less than a couple dozen of actual people engaging with this kind of programs is going to be the norm. But it's good to see that they try stuff, they'll see how it works, see what sticks, and then modify things accordingly. And hopefully that the 2% down program, no program is perfect. The best thing is to see, try, and then to kind of modify it as you see fit. But I think it's a good step forward, and I hope to see more of these kind of programs, or just changing of the program, so more people can get into houses at the end of the day. I know they're pulling a lot of levers. Supply is a big one. Affordability is another. They're pulling on all the levers, trying to get things moving. But like I said before, financial tools are easy to turn on and off. Turning on supply for housing is very difficult, very slow, takes years. And even with improvements, it's still going to take some time. But we are seeing some positivity in that sector, especially with the amount of condos coming up.
Yeah, I'm really happy to see that our province is engaging in these programs. Like I said, I do mortgages in other provinces, and out of all the provinces that I do work in, I see that the program in this province is probably one of the best. Now, on topic, off topic, I would love to see a program rolled out in Nova Scotia that they have in Newfoundland. So they had allowed a lot of in-law suites, a lot of homes to be converted into legal in-law suites. So basically they defined and changed the rules for what is a legal in-law suite in Newfoundland versus what it is here. And that allows a lot of more young people to get into the market because they can add rental income legally. Because if you have an in-law suite that's not conforming, that's not properly zoned, a bank doesn't want to touch that, a credit union doesn't want to touch that. But as soon as they say, yes, this is conforming, yes, this is fine, yes, we'll change the zoning, and now you can turn your basement, if you have a split level house and you have two entrances or whatever, one entrance, and you turn your bottom unit into an actual unit, and it becomes legal very quickly without having to go through the hoops of getting permits and rezoning, which in this province is crazy still. It's still hard to rezone and get permits. It's quite a bit, right? There they have just allowed for this to happen over a quick period of time. And so what you're seeing is a lot of regular houses converted into 2-unit properties, which allows people to get into the market a lot quicker. I would love to see a program like that rolled out in this province, because I think that would help quite a few more people with just the income situation, right? Because if you had a basement unit, for example, you're thinking, okay, well, how is this going to help me? Well, if you have a 2-unit house and it's a legal unit and you could get at least $1,000 a month for rent for that legal unit, your income goes up by 12 grand a year. That significantly increases your affordability on what you can get.
Just to close off, if I can say one more thing, would be the most expensive thing that I've seen for most people is being shy. Nothing has been more expensive than that missed opportunity. So what I encourage everybody, if they can, if they want to reach out, I don't bite much, but please reach out, email, text me, whether it's about buying first property, investing in properties, or just becoming a realtor. I'll answer any kind of questions. Please feel to. How about yourself?
I really appreciate you talking with me today about this. Outside of camera, you and I talk about this all the time. So it's nice to do it in a professional setting. I think that this is going to be a good program. I look forward to talking to clients about this and seeing if this is a good fit for them. Thank you.
Thank you. See you at home.